Have you heard about one-time close construction loans? Maybe you've thought about building a custom home. Maybe you have a client that's looking at doing that. Right now, they may be concerned that at the end of the construction period, where are rates going to be? Stay tuned and listen in on how a one-time close can help eliminate that interest rate risk for your clients. My name's Miles Pitcher. I'm the owner of Superior Lending, and I'm a loan officer here in Utah. I want to talk to you today about the one-time close. I'm changing up the order of my videos a little bit. Normally we cover rates. We're going to put that at the end of the video. And I also have some really cool economic charts and graphs that show some things happening in our US economy. What is a one-time close? Where we need to start is how typically construction happens. If you want a custom construction built home, you generally are going to a bank or a credit union to get a construction loan. During that construction period, it's great. You take draws from the bank. And then once the home's finished, then you have to refinance out of that construction loan into a long-term loan, like a 30-year mortgage or a 15-year mortgage. In the past, that has worked great because our rates have been very constant and very low. And we've helped our clients just to get those really low long-term rates. But now with the projection and the move with it, we are seeing that interest rates are on the rise. We need to be able to be aware of and include another option for our clients. And this is the one-time close. What it allows our clients to do, and we'll go into the details, is they only have to do one loan application, one closing, one set of fees. Because when you close on your one-time close construction loan, that becomes your rate for the 30-year mortgage. It's pretty cool. Let's get into some of the details on this. Right now, and we are on March 3rd right now, rates are in the range of 4.125 to 4.25. This is a portfolio product held by the bank, and therefore it is not as volatile as some of our other rates that we have. It tends to be fairly stable. A minimum down payment is 20%. If you buy the lot that you want to build on, that counts as part of your 20% down, the value of the lot or what you paid for it. It must be owner occupied. It can be a second home, but it must be a single family residence. I will also mention that if you are going to owner occupy a triplex, fourplex, this will work for that. The rate is a bit higher for those triplex and fourplex products. The term of the construction loan is up to 12 months. You can extend beyond that for another fee. We can do these loans up to $3 million. The down payments increasing from 20%, 25, 30% down payment up above 1.5 million loan amounts. It takes about 60 days to get this loan through underwriting, approved and done. The cool thing is that when you start the process and submit in your loan application with all your supporting docs, we can lock your rate for 90 days. So even though we're afraid rates are going to move up, you have that rate lock in place. And then as long as you close within 90 days, you'll have that rate. Let me throw in a note right here. Sometimes we have clients who have their plans drawn, they have their building permits from the city, they are ready to go. And they have enough funds that they want to actually start the construction while we are still working on this one-time close construction loan. Maybe they're going to excavate and start pouring footings and foundations. That is okay to do. When the one-time close loan closes, the title company will come in. They will make sure that every bit of work that has been done up to that point has been paid to all the subcontractors, so that any mechanics liens that they may have against the property are cleared off. They check with the state lien registry and make sure that those are all cleared off. Some of the keys here is the builder must be experienced. They must be licensed, bonded. They have to be legit builders. I did mention about starting construction during the underwriting period. One other thing here also on the fixed bid. With the volatility in building materials right now, sometimes we see builders saying this is a cost plus build. That does not work for this loan product. It has to be a fixed price build job. So for example, I had a client 2 weeks ago who came to me and wanted to do this loan product. They had a fixed price from their builder that was $1.1 million. it wasn't cost plus 20%. So it worked out great for those guys, and we're helping them work on their loans. Right. Let me know if you have any questions on this. This is a great product to be aware of and to be able to help your clients. We're finding that with the housing shortage, a lot of clients are moving towards custom builds so they can get exactly what they want. And this is a tool to help them because it eliminates the risk of what will interest rates be when they're done building their home. Now, is there anything to stop them from refinancing once the home is done and maybe rates are better? No, they can totally refinance to a lower rate if rates are better at that point. But if rates are worse, they can stay put and pay this loan down for 30 years. All right, let's jump in here. U.S. economy. This is a cool chart graph that I received the other day, and I liked it in that our economy is doing really well right now. But what could totally derail our economy? And you see as things move higher on the chart and to the right, they become more severe or could have more impact on our economy. Financial market sell-off, Federal Reserve missteps. We'll talk about the Federal Reserve in a minute. Geopolitical conflict. That is very much what Ukraine and Russia could be affecting us right now. If Russia's invasion flows over into other countries besides Ukraine, that would essentially trigger World War III or another pandemic. We've seen what the pandemic can do to our economy. So it's kind of cool to be able to keep those in our mind. Along the same thoughts here is check out this timeline. Look at the things we've dealt with and what we know is what we are facing in the future. We know there's going to be interest rate hikes with the Federal Reserve, Ukraine, Supreme Court appointment, midterm elections, getting inflation, and then even looking forward to the future on what's there. And all these things will have an effect on our rates and our economy. It's pretty cool to look back and see what we've dealt with in the past. I really like that. All right, where are we at on rates today? So, boy, remember this is an inverse chart. So the trend has been moving down in the chart. That means our rates have been moving up. And we hit this resistance line right here at 100, and we tested it and we held it. It was great. That put a nice floor in. And then we had the war with Ukraine and Russia start. And typically with war, there's a flight to safety with money. And so that moves into the bond market, mortgage-backed securities, and that helps improve rates. And that's what we saw for 3 days in a row. Really nice improvements. And then what happened right here? We had a double whammy, and that was the State of the Union address, and then Jerome Powell, the chairman of the Federal Reserve, testified and made some comment. So, number one, the State of the Union, they did not address in there what they were going to do about our oil reserves and our energy independence. With that, what happened was then it didn't look like oil production in the US would increase or be allowed to do more fracking. So the oil prices have shot up. The price per barrel has gone way up. That has hurt our interest rates because that's an inflationary item, and inflation is the enemy of mortgage rates. Then on top of that, Jerome Powell, who has been talking about these Federal Reserve rate hikes, and that is the Federal Reserve's lever, or their way to get inflation under control, is by raising the Fed funds rate. We know in March they're raising the Fed funds rate. Boy, there was speculation that it would be 25, then 50, and maybe even 100 basis points. He backed off in his testimony and talked about only doing 25 basis points, which means the Fed funds rate is going to be slower to get inflation under control, and that is the enemy of mortgage rates. And that's why we had this reversal right here and our chart dropped and our rates started getting worse again. So there is a lot happening with the pressures and influences on mortgage rates right now, but the big picture, they're still really good. We're happy where they're at, good affordability for our clients. Let me know if you have questions on this. Again, this month in March, we're going to have the Fed funds rate raised. Your clients will need to know, or people will be asking about, oh, I heard they raised rates. Those are not tied to mortgage rates. They are totally separate. Here's my contact info. Again, my name's Miles Pitcher. I'd appreciate it if you would like and subscribe to this channel. It helps us get word out and increase our base of influence. Have a great week. We'll be back next week with another tip for you.